Sticking to our lane means we can spot the real risks, like oversupply in a certain postcode. It means we're never forced to sell a property at a loss just to cover a rough patch. We want to be able to sleep well at night. What if interest rates hit 7%? What if rents fall by 10%? Transport links, employment growth, and that knowledge keeps our capital safer than chasing every hotspot. If a deal doesn't fit, too much debt, dodgy area, overpriced, we pass. Hi everyone, thanks for clicking on this video today. Today I want to talk about something that's at the heart of everything we do in property investment. Managing risk. Specifically, how we protect capital. I'm going to be really honest with you, no fluff, no jargon, just the plain truth about our strategy. Because when it comes to your money or ours, there's no room for messing around. So let's get started. First off, I'll say this, we're not perfect, no one is. Property investment here in the UK isn't a golden ticket to millions overnight. It's a long game and it comes with risks, market shifts, interest rates, unexpected repairs, you name it. But what we've learned over the years is that you don't have to gamble. You can protect your capital and still make solid returns. Here's how we do it. The foundation of our strategy is simple. We don't chase every shiny opportunity. We focus on UK residential property, houses, flats, HMOs because it's what we understand inside out. We're not flipping commercial buildings in London one day and buying holiday lets in Cornwall the next. Sticking to our lane means we can spot the real risks, like oversupply in a certain postcode or a shaky rental market before they bite us. It's not glamorous, but it keeps our capital safe. Here's something we live by. Always having a cash buffer. I know it sounds basic, but you'll be amazed how many people skip this. For every property we buy, we set aside enough to cover at least 6 months of mortgage payments, plus repairs or voids. Those times when a tenant moves out and no one's paying rent. In the UK, where interest rates can fluctuate like they did recently, that buffer is a lifeline. It means we're never forced to sell a property at a loss just to cover a rough patch. We want to be able to sleep well at night. Now this one's a biggie for us. We try to buy properties below market value or at least identify the value potential we can add. It's not about being clever or sneaky, it's about building a safety net into every deal. Let's say a house in its current condition has a market value of £200,000. We aim to get it for £170,000, maybe £180,000. That gap, it's instant equity. If the market dips, we got breathing room. We're not banking on prices soaring, we're just making sure we're not overexposed if they drop. It takes patience. And yeah, we miss out on some deals, but it's worth it. Before we sign anything, we stress test it. What does that mean? We ask hard questions. What if interest rates hit 7%? What if rents fall by 10% in that area? What if the boiler breaks down in year 1? We run the numbers, worst case scenarios, and if it still works, we're in. If it doesn't, we walk away. For example, we passed on a block of flats in Bristol last year. Looked great on paper, but the numbers didn't hold up if rates spiked. Turned out to be the right call. It's nothing fancy, but it protects us and our investors. Diversification is a buzzword, right? And it matters, but we don't overdo it. We spread our investments across a few solid UK towns, say Liverpool, Manchester, Glasgow, places with strong rental demand and steady growth. But we don't buy in 20 different cities just to say we're diverse. That's a recipe for losing focus. By keeping it tight, we can really know those markets, local schools, transport links, employment growth, and that knowledge keeps our capital safer than chasing every hotspot. We're not about luxury new builds or Airbnb hustles. Our goal is long-term tenants. Why? Because a tenant who stays 3, 5, even 10 years is gold. It's steady income, fewer voids, less wear and tear. In the UK, where tenant rights are strong, we treat people fairly. fix things fast, keep rents reasonable, and they stick around. That stability protects our cash flow, which protects our capital. It's not flashy, but it works. I'll be real with you, we say no a lot. If a deal doesn't fit, too much debt, dodgy area, overpriced, we pass. It's not because we're afraid, it's because we've seen what happens when you stretch too far. Back in 2020, we nearly bought a block of flats in Liverpool. Gut said no, numbers said maybe, we walked away. A year later, the developer went bust. Saying no saved us a fortune. That's not luck, that's discipline. So that's our strategy in a nutshell. It's not rocket science and we're not reinventing the wheel. We protect capital by being careful, borrowing even, buying smart, holding cash, planning for the worst. We've made mistakes, learned from them, and we're still here, growing steadily. If you're thinking about property investment or maybe working with us, I hope this gives you confidence. We're not promising the moon, just a solid, honest approach that keeps your money safe. That's what matters to us. Thanks so much for watching. If you've got questions or just want to chat about property, drop a comment below. Hit the like button if this was helpful and subscribe if you want to see more videos like this. I'll see you on the next one. Bye bye.